Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm, and I will be your host. So today I'm joined with Oliver Rust. How you doing today, Oliver?
Really well. Thanks a lot for having me on the show.
Good. Well, glad to have you join us, and we really wanted to invite Oliver on. It's one of my favorite topics that we're going to be talking about today, and listeners are probably all sick of me hearing about this, but we've been talking about this for the last 2 years, and it's important, and I think you all realize that now. But so we're going to be talking about inflation and all the details about it, which I think will be really helpful for listeners who, if you can't follow what I've been saying, here's somebody who's literally just focused on this and very little else. So what better way to get good data and background? So Oliver, can you tell us a little bit about your background?
Yeah, sure. So I've spent my whole career working around data, and whether it's data measurement, data applications, and transforming data to help businesses make businesses and financial institutions and sort of government organizations to utilize data to make informed decisions. So yeah, I've been working at a UK retailer called Tesco's. Post that, then I worked at a company called Kantar, and then I eventually worked at Nielsen. Did various different measurement tools for Nielsen, whether it's TV ratings, whether it's retail measurement tools, whether it's in the US and Europe and Asia Pacific, and also then subsequent to that, I've been working in a CRM business. So quite a wide variety of data applications. And then about 18 months ago, I joined Truflation to help create up an alternative data source for inflationary measurement.
Nice. Well, I'll just caveat this for listeners. We're not going to be boring the tears out of you talking about data today, but we're going to be talking about what's behind that and how it works and all that. So don't turn off your podcast yet. We're going to it's going to get interesting. So Oliver, I wanted to kind of talk about this, and why did you start Truflation with an alternative data set? Isn't the CPI good enough?
Yeah, so that's the big question, right? Our viewpoint, it's not, right? And it's nothing wrong with what the BLS has done. The BLS has set it up. If you go back in history, I think it was the first time it set it up. It was in the First World War, I think it was over nearly 100 years ago. And the methodology has evolved a bit, but we're now living in a time where digital is around, e-commerce is massive, the whole digital platforms, how we're interconnected. It means more and more data is available, right? And so doing a standard price check where you send people into the field to look at what the price is for goods and services in today's world is just not wrong, but it's just archaic. And our focus was designed to try and modernize that and bring that into the 21st century.
Okay, so let me ask you this. I mean, obviously,
how did we do it?
So obviously the data has changed and the calculations have changed over the last 100 years, whatever it's been. So why do they keep changing? I mean, they just made a change this year. I think it was in January. So why do they keep changing the calculations for inflation? Shouldn't it just be the same?
Yeah, so let me quasi preference this with just how the BLS set it up first. So the BLS is a monthly price check tool that measures the price of goods and services, about 80,000 items they check on a monthly basis, right? And you have to base that 80,000 items that they check on household expenditure levels, right? To create an average household expenditure. So how much do you spend on grocery items? How much do you spend on housing? How much do you spend on energy? How much do you spend on transportation, and so forth? And so that when you do those price checks, the way the BLS does it, they have to weight that up into those averages. So for example, if you spend an average of, 15% of your expenditure goes on food, then they need to weight the pricing against your category of baskets. So what the BLS has done earlier this year is they've updated the frequency of which the household expenditure survey that they do is updated every 2 years rather than I think it was every 3 years or something like that. It's updated more frequently, but in a lower lag. I mean, so a more recent data set, but they update it more frequently is what they've done. So, and that is the right approach to do it, right? We do exactly the same. But at Truflation, what I think is important is you've got to think about updating this as frequently as possible, because if I look at data that's a year out of date or 2 years out of date, especially what the consumers have gone through and households have gone through in the last 2 years with the pandemic and the quantitative easing earlier this year, earlier in this 2 years ago, and was running that through. Our expenditure behaviors have changed, right? We're no longer spending what we used to spend or the percentage amount we used to spend. So using old weights to project the CPI is where the issue comes into play.
So, I think one of the challenges for a lot of people is, you see this inflation number this year went up to 9%. Now it's at, 5% or a little bit below, but it's right around 5%. So if you're looking at that, and then you go to the store and you're seeing 20, 30, 40% inflation in certain goods, people think that the measurement is wrong, right? I mean, how can you have oil prices, gas prices, energy prices, food and goods going up that much, and yet we only have 5% inflation? It doesn't make sense to a lot of people.
Yeah, and I think that's what a lot of people forget with these numbers, right? These are just year-on-year percentage changes, right? And if you look at this, about a year ago, we're running at nearly 9%, 10% nearly, and those are really high numbers that we were facing. And what we're looking at this year is, yes, it's a 5%, 4.9% was the last release. It's still 4.9% on a really high number. So if you look at actual prices that people are paying, they are still going up, right? They're not coming down just because the rate of inflation, just because the rate increase is slowing down. The prices are not coming down. They're still going up, and they're going up on a high base on last year. And so, yeah, that's the issue for us is from a consumer standpoint, your prices that you're paying is going up, but everyone still thinks this number's coming down, and therefore it's going to relieve on price pressures. Until it gets into a deflationary environment, then the price pressures will start to alleviate.
Right, but what I'm saying is that there's a big discrepancy in percentages, right? If you're getting a 20 or 30% bump in what it costs to fill your cart when you go to the grocery store compared to getting 5% on the CPI number, that's what I'm talking about. People don't believe the CPI number because they're not seeing that in their shopping cart. So, how should people interpret that?
Yeah, no, 100%. I think that's the issue, right? We all experience price increases in multitude of forms, and depending on our personal expenditures and how they change, we're going to see price inflation differently. What you spend your money on versus what I have to spend my money on will result in different expenditure patterns and therefore different levels of inflationary pressures. I will say, however, that dealing with 80,000 items that the BLS does through a monthly basis by doing standard price checks, in my view, doesn't give us the most accurate measurement that we're dealing with on inflation. So when we look at it with 15 million different items, right? So the volume of data matters in this world, right? And if you can work directly with the sources like retailers, when you can work with retail aggregators to collect all this data, you can use that as a far more accurate source of price changes in the marketplace than what you're basing on when you're looking at, 80,000 items divided by the food category that's in there on a monthly basis. What is that? It's probably about maybe 5,000 items that they're checking. And you got to do that nationwide across all the states. It's just not, in my view, it gives me goosebumps every time I talk about this, because I don't know how you can measure accurately price changes across the states on about like 5,000 items. It just doesn't give you a accurate feed of price movements.
Yeah, it's been interesting because over the last 15 years, spent time following inflation and tracking it myself in a more manual fashion, just to get in the weeds and really understand, because people have been talking about how the CPI has been manipulated for years, and there's a company called Shadow Stats where they take the original and they compare the original to what it is today and what it would be, and so it's just interesting to see the differences. So when I was looking at it, there were a few places that tried to do this. I think Google did it. It was like the price of everything, or there's some sort of thing they did like 10, 15 years ago, and then they stopped. They did it for a year and then they stopped. I don't think they stopped, but it was stopped being public. And I think they sold it to institutions. But I thought it was interesting because they were using like Amazon or places like that to check prices. And I guess it kind of comes back to this point of you have like something like Shadow Stats that talks about like the original CPI, and they kind of measure and they're like, here's what it should be. It should be like 15%. And it just brings in the issue of like, how can there be such a difference, even in the last 100 years? How can there be such a difference between like 15% and like 5%? And I think people are feeling the 15%. And so I guess, I don't know, maybe there's no answer to my question, but I'm just trying to get a sense, because this is how the public is feeling about it.
I think there's the way I'd answer that is, in my view, that there'll probably be a combination of factors that's involved. Is one, we're not all spending money on the same categories as we all are, right? So some of us maybe don't own a car, so you don't have to pay petrol prices directly, for argument's sake. Some people spend a higher percentage of our money on grocery spending. Some people have a higher expenditure on healthcare versus others, and so forth. So, and some categories have a higher price point pressures than other categories do. And so I guess that's one area to look into that would help to explain the differences that might be in these data sets. I think the other thing in reality is, if I look at the BLS numbers, there's a lag in their numbers, right? I assume at an absolute minimum, there's a 1 month lag in their numbers. I assume it's rough, on average, it's a 3 month lag, and on housing, it's a 9 month lag. So, you got these huge lags in the BLS data that can affect different volumes of expenditure behavior. So that's also another reason why these price points are different to what we're seeing. And then I think the third aspect of it is just, we are changing our consumer expenditure patterns every day. They're just not static, right? We cannot believe that, the pressures that households have been facing under the last 18 months or so, 24 months, has not altered the way we spend our money, right? We can't just assume 2 years ago is the same level as what we're spending today. It's not, right? And people are looking to save money. They're looking to deal with promotional activities a lot more effectively when they go grocery shopping. They're looking to buy better deals, and all this stuff is changing. And so that also needs to be reflected in those numbers as well.
So I want to get back to some of the things you said. So you talked about the composition. So this brings in a question, right? We've got 350 million people in the US. Everyone's different, right? Some people are dirt poor, some people are uber wealthy, and everyone in between. So what's the best composition? I mean, they're coming up with a composition, but what's the best composition? What's the best way to do it? Because the inflation rate of the uber wealthy is very different from somebody who's barely, who's on food stamps and can't pay their monthly bills. So how do you choose the best composition for the inflation rate?
Yeah, so the way to do that is to look at as much as you can as census or volume data. Think of that, census level data, right? So you don't want to be reliant on 5,000 data points across, let's say, food categories across all the 50 states in the US, right? It's too little, right? And the variability, even within a state, is different, right? So if you look at New York State, what you're paying in downtown Manhattan versus outside of New York City, it's very different price points, right? And so I think somewhere, having a census level data and the depth of data is a critical aspect to have to be able to compensate for this. So I think the volume of data matters absolutely everything what we do. And what we found was really interesting is it's not necessarily the geographical split or where you live. It's actually the income levels that matter and how those income levels are spending. So if you happen to live in New York City versus LA, if you were at the same income level, your expenditure patterns were roughly the same. So the geographical spread really wasn't that much of a difference. It was more just how we spent our money based on income levels. And once you moved and progressed from one income group to the next income group, that's where we saw shifts and change of expenditure behaviors. And to measure those expenditure behaviors accurately, you just need to have volumes and volumes of data. And you cannot base anything on, you divide the 80,000 the BLS users, divided by the number of states, divided by month, divided by categories and subcategories that they track. It's just, you start to get down into, quite small numbers, and that's not a good situation to be in.
So, all right. So income is the best way to look at it, but still you have people with different levels of income, right? And then you also
Yeah.
have people that, you know, look at college. College on average is about like 7.5% a year for like the last 20 years is inflation. And if you don't send your kids to college, it doesn't really matter, right? And you know, when you are, it matters, but until then, it really doesn't matter to most people, right? So there's all these different things, and so I guess it's good to know that the income is the determining factor, but still, even with income, people's expenditures are very different, right? If
Yeah.
I make $10 million
100%.
a year, I'm buying Mercedes and whatever, and or you know, watches or whatever my money's going to. But you know, if I can't, you know, if I can't barely pay the bills, I'm not buying any of that, and I'm focused on food. So very different inflation patterns based on the public.
And not only that, if you are a two-income household family, if you got no children, right, all these things change the expenditure that you have as an individual versus another individual. Even if you're on the same income levels, right? You know, you could have someone who's got two children versus someone who's got no kids, and you don't have to worry about the education expenditure. So therefore, that means you got more money to do other things with, and that changes. So you've got to have this. That's why this volume of data and this the census level data is critical to establishing that, because you remove that variability. If you're picking one or two items and then basing that on your price checks, you're not looking at it from a consumer point of view, you're looking at it from a store point of view. So yes, a price of, you know, when you do a price check and you go into a supermarket, for example, grocery store, for example, and you buy a pint of milk, that pint of milk has got a cost against it. So it's a cost of a dozen of eggs or a 6 of eggs. And if you go back, and these people might have said, well, I've actually might have down traded into a house brand, for example. I might have bought the Walmart Savers brand instead of buying a national brand. I might have gone into and bought a product on promotion. I might be downscaling. I might, instead of buying I don't know, half a kilo of well, let's say 500 ml bottle of water or of Coke, I'm now buying a can of Coke, for example. And that down trading, if you're only looking at the price points, you're not getting that change of consumer behavior in that, when you're only looking at the price point of that 500 ml bottle of Coke, for example, right? And that's also another factor, right? Because products, if you go back in time, products have always gone up no matter what, right? They've always increased, right? And it's a question of then saying, you know, how do you accurately measure that, and how are consumers dealing with that? Because either consumers accept that price increase and continue to buy it, or they don't, and they either down trade or forgive buying that product. And so therefore, if you're checking a price point into that product and you're not buying that anymore, or you don't understand the volumetrics behind the purchasing, creating prices and looking at price checks loses relevance.
Yeah. So let me ask you this. So they just changed the makeup of the CPI, and I think it was January. And one of the things I noticed is it had a bigger increase of impact on housing. I think it was like 45% or something like that, which is enormous. I don't spend 45% of my income on housing. Now, I don't know what the national rate is, but I think mortgage companies look at 30% as their marker for getting a mortgage. So, you know, A, why is it that high? And B, you know, 45% of housing crashes 20%, then we're going to have a negative inflation rate. So how does all that kind of fit together, and what does that look like?
Yeah. I mean, I think so the way they define housing is consistent. I mean, Truflation, we measure it up. I think we're at 23%. I think what our expectation is of household expenditure. And household expenditure for us is built down into what you spend in rent, what you spend in, if you own it, what your mortgage repayments are. And I think the final thing is what you're doing in your house. Like if you're doing any maintenance work, if you're in insurance, household content insurance, for example, any maintenance upgrades you're doing and that type of stuff. So they have a pretty holistic, I think if memory serves me correct, they have some utilities in the housing number in BLS as well, which makes that number a lot bigger. So taking all that into account, I think the breakdown of trying to understand what that 45% number is important. But having said that, there's another issue, which the BLS is that the BLS has, which is the BLS is measuring housing in a very difficult way. So housing is probably one of the most complex categories to measure price change in. right? So let's start with that. And the way they do it is the BLS tracks, I don't know, I think it's something like 18,000 interviews over 6 months in housing and rental. So what is that? So you're looking at about something like 2,500 per month is what they're looking at. So, they 3,000, what they're looking at per month to determine rent across the whole of the US. So they do a survey on 3,000 individuals every month and says, what are you paying on rent? And then they take that data and they call what they call owner occupied rent, OER, and they take that OER and they say, okay, the rent, what you're paying in that is you're living in this location, in this suburb, in this county, in this city, in this state. And if we move you from that suburb to that suburb, therefore you own that house, and now you suddenly, instead of having a 2-bedroom apartment or 2-bedroom house, you now have a 5-bedroom house, and therefore we'll model the value of that property up based on the rent. And that is, in our view, is just, it's one way of doing it, but you cannot rely on that as a form of determining what rent is, because your mortgage, what you have left on your mortgage versus what your neighbor has left on your mortgage is very different scenarios, right? And are you on a 15-year? Are you got a 30-year? How much is left? What's the principal versus the interest rates, all this stuff. So, and then also all the taxes in each county are different, right? So then you have to project for that. So the way we suggest to do it is by looking at this by using multiple different data sets on housing. And so we use housing prices because that's a big influence and factor. I think we also use mortgage information, and we also use tax information, right? And we combine all that together to create an average, right? And based on all the data sets that we're seeing, we use 8 data sources in the housing category. We're seeing that the BLS is lagging by about 9 months, right? And that is a big factor in consequential factors in understanding how the Fed then determines these interest rate hikes. Because I don't know, in our view, I think there needs to be more data sets at the Fed discussion points and alternative data sets. It gives you a different viewpoint of what's happening. It's a bit more up to date and a bit more modern in the way it's being tracked as an alternative data sets. And I think that's why we're trying to play that role in. So I hope that gives you some context on the levels. I can't speak to the BLS and why they're at 45%. I hazard a guess it's a category definitional issue if you include utilities in there and stuff like that. But I think overall there is a fundamental need to modernize the way that the BLS tracks owner-occupied housing. And so your owned rental, right? Your owned property, how much are you paying back on your mortgage? And their assumption is, well, if your neighbor is paying this on rent, you're paying equivalent of that in mortgages. And I think that's wrong.
Yeah. I mean, I think you could argue that, whether you rent or own, it's a personal expense, right? And we could argue whether it's a good investment. We certainly talk about that in the show a lot. But the one thing that kind of comes up is, wouldn't it make sense to just have like a few different numbers, like have one number, right? But have like, for people in this income range, 0 to 50,000, here's your inflation rate. People from 50 to 200,000, here's your inflation rate. So like, so people can kind of identify where they are, because I think, I haven't heard anybody who's like, yeah, the CPI is pretty accurate. Like that feels accurate to me. Even not in the last 2 years, but prior to that, when I would argue we even had deflation, but it was not showing up as deflation. It was borderline, but there was a lot of deflationary pressures, and we could maybe talk about why that's happening. But to me, it just seems like it's always off. It always kind of fits in this range, but it's always kind of off from where it should be. It doesn't seem to be accurate. And that's not me. That's like, I was pulling up data points from like, I don't know, maybe 20 or 30 different sources, government sources, and looking at data points and saying, well, this is showing it's going down. This is showing it's going down. Asset prices are going up, but everything else is going down. So, it just seems like there was a disconnect regardless of whether inflation's high or low. It seems like they're trying to keep it into a range. So it feels to most people like it's managed. even though it may not be, but it seems that way, because otherwise, how else can you describe why it's showing up what it is?
Yeah, and that's our viewpoint as well, right? Whether I believe it's managed, but it does come across like that. And if you whatever you're paying rent in a certain location is what you're paying rent, right? If you live in this zip code versus that zip code, the rent in that zip code is roughly X. Yes, you can get a better apartment, a less apartment, bigger or smaller, but the rent is X, right? And no matter what income level you are, you're paying X rent. Now, you might decide to share, if you're a young student coming out of university and you're getting your first job, you might share a rent, you might share an apartment, right? And so those factors come in, and therefore the importance of that housing expenditure, that rent expenditure, is less than if you took a whole apartment, for argument's sake. And again, it comes back to what you spend versus what someone else spends versus what I spend is different. But yes, so for me, it's not necessarily about looking at the income distribution, which is a critical element. Don't get me wrong; it's still a really important element. But when you're dealing with things like housing and rentals, the rent of a property in X location is Y, right? That's what the cost of rent is. You can negotiate it. If you happen to be there on a rent control, you might get a lower increase year on year. All these circumstances start to come into play. And I think somewhere that is what we're trying to do, is look at that and again, in volume and depth purposes, rather than taking an approach where your rent then equals your mortgage repayments, because they're two very different scenarios, right? And it's not easy to measure housing, I grant that. And I think because of the way they're measuring it, they've got this lag in their data set, which makes everyone think, well, actually, you got this lag in this data set, you're off. It feels wrong, right? And it doesn't feel that it's applicable to what I spend in my housing and my cost of living. And I think that's one of the factors that comes across there.
Okay. So, so let me ask you this. So you have access to a lot of this data. Does it have predictive value? Like, if you're looking at all this data, and I'm just curious, you sit in this all the time. Do you where do you think inflation's going based on kind of like what you're seeing?
Yeah, so first of all, yes, we do predict, and also predict has huge, significant predictive values. We predict obviously the month ahead, and then a short term, like 2 or 3 months down the line, and then we predict the remaining part of this year at the present time. We haven't started predicting into 2024 yet into our models, but certainly we are of the belief that inflation is here to stay. I think there is an element of quantitative easing and money supply that's now being restricted and being reversed through the interest rate hikes, and we're going to sometime soon, we're going to start to see some quantitative easing coming back into the marketplace, which is then going to result in spending going up. I think the other scenario is the data sets that we're looking at is that the credit spending is through the roof, right? Credit card spending now, I think in the US is somewhere around, the last quarter update was $990 billion. Delinquency rates are holding, they're marginally going up. And so I think somewhere and household mortgage debt is going up. I think what's the latest report from the New York Fed said household debt rose, I think, up to about $17 trillion in Q1, and that thing is still increasing, right? And so people are still spending. And so that's fueling, obviously, the delay in a recession, in my view. But I think it's also keeping these prices up and prices going through the marketplace. And inflation is definitely going to be here to stay. Do I think it's going to drop down by the 2% by the end of the year? Or do we think that? No, we don't. I think the target rate that the Fed has set at 2%, you can have another whole discussion about that, how that got derived, and is that the most accurate measurement to be having in place. But put that aside, I think that 2% is not going to be a target that's going to be achieved this year. And most likely at the end of this year, I think you're probably going to look at inflation hovering around 3.5%.
Based on housing, I think the big interesting point is housing, and housing is such a big part of the composition. And yet last year, even though the rates of what you would have had to pay to buy a house virtually doubled, almost doubled, and yet the median home price went up 10%. And it seems like there's a big disconnect between the price of housing and the affordability, which is not being realized in the market yet and not being realized in the data because people don't have to move. So it brings up the point of, at what point does housing really dramatically impact the CPI? Because if housing really makes up that big of a part of it, at some point it should, and this is why we kind of, tongue in cheek predicted inflation would be zero by the end of the year. I'm not going to sit here and say absolutely that's going to happen. There was a chance based on housing, but it depends on how they calculate it. But having that much of an impact, the point was to illustrate the fact that, housing has such a big impact that it could happen. But it doesn't seem to be, because housing doesn't seem to be moving in price as much as it probably should.
I think there are two factors on here that I think we should be mindful of. You're right that if you look at other government stats, well, at least by the Census Bureau, yes, median price is up. The number of transactions is up, right? I think it was up to 680,000 transactions this last month. And that's been constantly increasing in the last, 6 months. The median price has been going up. The average price has been going up. So and we look at data from Zillow, CoreLogic, Trulia, Apartmentlist, and blah blah blah. All these data providers, they're actually showing now prices going up, right? With interest rates still this high, prices are still going up. And so that's one area that I don't see pricing coming. Housing should have come down already, but now we're seeing the surge back up again. On maybe it's on the anticipation, but there is a second factor here, which is normally in the summer months in the US, we expect people to move around. There's a lot of movement within the US where people are finding new jobs elsewhere. And we have not seen that movement to the extent we have in prior years, in the last couple of years. So, that has caused a bit of a concern for us, to saying that generally also moves price and that drives price up. And so we haven't seen that movement. That's a bit of a concern. And then also, finally, if you look at the supply of housing, what's coming into the market, a lot of the supply that was meant to be coming into the market has been delayed. And that is also probably causing the prices to stay high. And so culminate all those factors together, I think that housing is a critical factor in household expenditures, but it's only one of the four main buckets, right? So you got housing, you got food, you got transportation, and you got your utility bills, your electricity and your gas bills and water bills and blah, blah, blah. And I think those four buckets are the big buckets that we got to pay attention to be able to track what's really going to happen on prices.
So let me ask you a final question before we kind of wrap it up here. Is it gets into it's certainly prediction, and obviously we all know about predictions that they're a guess, but we look at the inflation rate, and looking at your site, it looks like inflation rate was about 12%, close to 12% about a year ago, and now it's down to like 3 and change. So you predicted that they'd probably have to institute quantitative easing again. I think it kind of brings up the question of that we raise on the show, which is, what is the one thing that is what's the one lever that's going to move the world? And it's like, what's the Fed going to do? Are they going to allow? Are they going to keep rates high to suppress inflation, or are they going to bend to Wall Street and just say, all right, we're going to lower rates again? I mean, to me, it seems like you got 5.25% inflation rate, doesn't seem to be bumping the economy along. We're not in a recession. Why would they drop them? What's the incentive for them to drop the rates?
Yeah, that's a really good question, right? I'm with you, right? I don't see what the incentive is for them to reduce rates. You look at a number of factors. You look at the labor market. Unemployment rates still ridiculously low, despite these hikes of interest rates. We have wage inflation. It's still relatively strong. Right, it's come down a bit, but still strong. So you got a hot labor market. You've got inflation that hasn't really come down. Yes, it's come down to 5%, but still nowhere near where the Fed target is. And you can argue the other major factor for the for the Wall Street is financial stability. You could argue that these interest rates have caused a number of banks to collapse, and then the final. So is that putting more pressure on them to worry about that? My sense is that the Fed is willing to help out institutions like they've done over the past with Silicon Bank, with First Republic Bank, with helping them transition to JP Morgan. I think you got other questions that come with that. But I think then the other factor for me is also, what are we doing from a consumer expenditure point of view, right? And we are still spending like crazy, right? Like you look at the retail sales data, that's still going up, right? The GDP growth, I think in Q1 was 1.9%, if memory serves me correct. And the retail sales data and the credit card debt that we're accumulating seems to suggest that we're delaying recession if there is going to be one. We're certainly delaying it with the rate of spending that we're going to do. So I don't know what incentive the Fed has to start reducing interest rates. I don't think they're going to increase. I think they're going to hold for a bit, but I don't think they're going to reduce. I don't know what incentive they have. So everything else seems to be holding until something cracks, like if we do go officially into a recession, or if unemployment rate suddenly starts to jump up, then things might change. But in the interim, based on all the data that we're seeing, I think the Fed is going to hold its trajectory at the current rate of not increasing, but not decreasing it either.
Yeah, it kind of plays into we're going to have rates are going to remain higher than a lot longer than people think, and the bond market doesn't seem to think so. They seem to think things are going back to quote unquote normal, but I don't see how that's possible given all the data. But I guess in this environment we live in the twilight zone anyway, so who knows what's going to happen.
And also you got to think about the other factor is what's going to happen. How much is the US a bellwether for other countries around the world? So like, what is Europe going to do, right? And so with the amount of US currencies that's around the world, it adds another factor, a slight equation into the ball game, but around the money supply and the quantitative easing, what's going to happen with that. But if that does come into play, but yeah, that's exciting times ahead. And I could talk about this forever, but I think that inflation will stay around, and I think we're going to see the Fed holding interest rates longer than the market is anticipating, is my view.
Well, I'm going to wrap it up with this one question because I feel like there's a general sentiment, but maybe not necessarily accurate, but it's the way most people feel. So why do you think inflation is happening now as opposed to 20 years prior when they were still printing lots of money?
I think there are a number of factors. One is, yes, the printing of money in the past. I think this is finally catching up with them. I think we've had a pandemic that we've overspent, and we printed a bucket load of cash during the pandemic. I think that the pandemic has also caused supply constraints issues, especially around certain categories, around transportation, raw materials, on food products, food supplies. I think we're seeing it on metals that's coming in. All that has then also translated into supply-driven inflation. So you look at things like raw material costs are going up, the commodity market's went up, it's now coming back down again on average. There's some more commodities going back up again, but generically it's come down. And that futures market has changed it. I think the other final factor that we've seen dramatically is also tariffs, right? The US government has put a lot of tariffs on imports of products and goods from around the world, in particular from China, but also from other markets. And that's also caused an increase in prices, right? I think the oil situation has caused a compounded effect. So all that together has caused where we are seeing an inflation today that we haven't seen in the past.
Okay, great. Well, I really appreciate you coming on the show, Oliver, and sharing your wisdom with us. Final thoughts, and where can people find more about you?
Yeah, just have a look at Truflation.com. That's where we're on our website. If you got any feedback, please let us know. We're keen to get as much feedback as we possibly can. If you've got any questions on how we do things, if you want to get access to data, feel free to reach out. You can reach us out there on Twitter, or you can reach us out on the website through the Contact Us page.
Great. Well, thanks again for joining us, Oliver. Inflation's probably not going away, so we'll probably have you on in the future to talk more about it.
Thanks a lot for having me on the show, Kirk. I really appreciate it.
Hey, Doug, did you hear? We're giving away free money. Well, I'll tell you about it in a minute, but before I do, there's a saying in the mining community, well, precious metals mining, that is. The saying is that if you want the best deals, you have to be in the room. Now, you're probably thinking, what does it mean to be in the room? Well, I'll tell you. Being in the room means that you're on the short list of people who get invited to be a part of the best deals. These are the deals that most investors will never have access to. You mean like IPOs? Nope, IPOs are chump change. Those are for retail investors, small potatoes. That's nothing compared to these deals. These deals would have you salivating to get access to them. Once you know they exist, you will never look at investing the same way again. I almost don't want to even tell you that they exist because it will ruin your thinking of how the investing world really works. Now, you might be excited that these deals exist, but you only have access to the deals if you're an insider, or in the room as they call it. Now, as loyal listeners to the show, I'm going to give you a chance to be in the room. Money Tree Investing Podcast has created the Insiders Club. This is a community of our show's members who are loyal listeners of the show and want to get more out of their investing experience. Being a part of the Insiders Club gives you insider status for upcoming events and webinars, discounts, free stuff and books, and influence on the future direction of the show. This is a great opportunity to join us as we expand our content and services. Oh, and did I mention free money? Yes, in the next few weeks, I'll be giving away free money to our members of the Insiders Club as my appreciation for listening to the show. Now, there's no cost to join the Insiders Club. Just go to moneytreepodcast.com/free money today to join the community. That's www.moneytreepodcast.com/free money. I hope to see you in the room. All right, well, that was a great interview with Oliver. Really appreciate him coming on the show. Great data. For those of you who like data, this was great. I'm a data geek, so for me, this is like Christmas in July. So, but now we're getting into the panel portion of the show. We have our very own Megan Gorman. Hey, Megan.
Hey, Kirk, how you doing today?
Doing great. Happy to have you on the show. And we also have our very own Phil Weiss. Hey, Phil.
Hey, Kirk, how are you? Happy to be here today.
Good. Glad to have you on as well. So Megan, what were some of your takeaways from the episode?
Yeah, first of all, I loved this interview. I find, people who specialize in data just fascinating to listen to. But I think what was so powerful about this is inflation is something that impacts all of us and it impacts all of our planning. And yet, when people are investing, when they're putting to their financial plans together, I'm not so sure they really think about it in the right way. So what I really liked about this interview is I think Oliver explained how nuanced it is, how complex it is, and really just gives food for thought. So, there was just so many little nuggets that he put out there that I thought were incredibly powerful, especially when you start to take it and apply it to your own planning.
Yeah, I totally agree. Phil, what about you? What were some of your takeaways from the interview?
Kind of like Megan said, I mean, it was a very interesting thing. Inflation is something that so many people don't understand. And when you mention planning, like people say, I'm worried about the market and they don't want to invest and they forget about inflation when they're coming to that conclusion. And there's so much data out there and so many different ways to parse it. And a lot of it, things that happen with inflation, we don't even realize.
Yeah, so let's dive into that. So, I know when we talk about inflation, let's kind of dive into the weeds a little bit. So Megan, from your perspective, you mentioned this when it comes to planning as advisors, like whether it's just individual clients doing it themselves, inflation has a big impact on portfolios, has a big impact on planning. So, how do you kind of work with your clients around incorporating inflation into the equation?
Yeah, it's a challenging thing because nobody ever wants to talk about inflation. It's not a sexy topic, right? But I think where you need to factor it into your planning is when you're really running long-term numbers, right? So what is a typical tool in the financial planning industry, and there's a lot of tools out there for do-it-yourselfers, is you can take a series of assumptions and stress test your portfolio based on your spend, how long you'll work. But I often point out to clients, and have always run this a bunch of different ways, is yes, we might have been at a period of time where longer term inflation was 2%. And when you run a long-term cash flow scenario at 2%, you might have success, right? Your money can last to your age 100. But what happens when you start to play with various scenarios where inflation remains higher for a longer period of time? And it's a really eye-opening thing when you look at this with your finances and you start to see the power of inflation eroding. And so I think by actually looking at analysis in that way, it forces you, or you and your planner, to start to have discussions of, well, what do you do when this happens, right? I mean, is it as simple as just lowering your expenses? And now, while that's one lever you can pull, it isn't the only lever, right? We need to be thinking about it then in context of the entire portfolio. And as we've talked about on the show in the past, each holding in a portfolio has a role to play, right? We tend to get focused on the things that seem exciting, right? That do really, really well. But there are certain things in a portfolio that, when inflation kicks in, can often help you battle it. And so these are the discussions that you can have if you really, really start to take inflation and stress test it against your numbers. And I'll be honest, it can also scare the crap out of you, because, you could have tremendous success, with a 2% inflation rate. But once you do 4%, all of a sudden it's like, oh my God, like, what am I going to do? I'm not going to have enough money. So I really urge people to think about inflation as a key metric in stress testing.
Yeah, absolutely. So Phil, what about you? How would you kind of incorporate this into portfolios?
So certainly stress testing is important. I know when I'm working on a plan with somebody, we look at not just the base inflation that's built into the software, but say, what if it's higher? And then the other thing that's a big source of discussion is, if you start to invest too conservatively, the chances are you put too much in fixed income, right? Well, fixed income right now, I can put money in a treasury and get 5%. That sounds great. But if inflation is higher than 5%, you're losing purchasing power, so that the value of what you have is going down. So you have to make sure that you don't just invest in such a conservative way where you can't get returns that are going to keep pace with inflation, or even hopefully run a little bit ahead of inflation. And that's one of the reasons that we want to invest in the market as well. But we want to make sure when we do that, we take a diversified approach, because in different environments, the reason that we have this diversified approach is because different investments respond differently in different environments.
So let's dive into that a little bit. So Megan, you mentioned this as Phil has. So what are some things that people can kind of add to their portfolio to account for a different inflation environment, or maybe to stabilize it for a higher inflation environment?
Yeah, no, it's there's a number of things you can do. In terms of fixed income, it's looking at things like TIPS, Treasury inflation protected securities. It's adding real assets, right? Private real estate funds are often a good way to hedge against inflation. The other thing I challenge people to think about is, one of the things when you're in front of a client, you hear consistently is, I want to just live off of my dividends, right? And, it's a lot about, well, okay, are we just looking for dividend funds, or are we looking to compound and grow the portfolio from a total return perspective? And so a lot of times, and Phil, I just saw you nod your head, so I want to hear your point on this. But a lot of times, like, clients just think it's just clipping the income coupons. And that's true a lot of times with fixed income. But on the equity front, we just want to sometimes compound, because it's much better to use withdrawal strategies, like a dynamic withdrawal strategy, where you take a mix of income and principal to live off of. So these are the things I think people have to factor into, their planning. And I would also say, for those do-it-yourselfers, when you build your asset allocation, don't hesitate to have certain asset classes like highlighted in different colors. Like, this is my wealth building, right? This is my conservative piece. This is my inflation protection. Because I think then it gets you to start thinking about the fact that, yes, I have this in my portfolio. It's maybe just doing okay today, but that's because we're in a low inflationary environment. I have it there because if things shift quickly, I want to be able to move and pivot in that direction. And Phil, I'd love to hear your thoughts.
that total return perspective that you mentioned, Megan, it's so important. I always think about, there's an old thing that I read years ago from Peter Lynch, and he talked about, like, if I buy a bond, right? Let's say it's got a face value of $1,000. I put $1,000 into it. It pays 5% interest. I'm getting $50 a year. Maybe it's a 10-year bond. At the end of that, I collect my $500 of interest over the 10 years. I get my $1,000 back, but that $1,000 is worth less in 10 years than it was today because of the effects of inflation. On the other hand, if I put that money into the market, into stocks, I like to think about my yield on cost instead of what my yield is relative to the current price. So let's say instead of what I just said, over that 10-year period, we put it into a stock, and I'm going to use the rule of 72, which says that you divide the number of years into 72, and that tells you how long it takes for something to double. So let's say that we have a 7% return. So in 10 years, it's going to double. So I bought $1,000 of stock. At the time that I bought it, it was paying a 2% yield. So I was getting $20 a year. Now we're 10 years later, those stocks grew at that 7%. So now I've got $2,000 instead of $1,000. And let's say that my dividend grew at the exact same pace. So now, instead of getting $20 of income, I've got $40 of income, right? So I want to think about that. I want to think about getting growth in my principal as well as the income. It's a total return. Total return is so important. A lot of people don't think about that, but it's really important to think about a total return perspective.
And by the way, I don't think it's that misconception is limited to just regular investors. I see it happen all the time, even in the high net worth space, where they just are focused on yield and not total return.
Well, I think there's another thing to bring into the perspective too, is I think, we all make assumptions that don't include time. So like what you were saying, Phil, like, well, you could get a 7% in stocks. Well, the question is can you get 7% in stocks, right? Like maybe over 50, 100 years, maybe that's the number, but at the top of the cycle, you're not getting 7%. And the bottom of the cycle, you're also not getting 7, right? So it's averaging out. So I think when you bring in time as an element in this equation, you have to account for that too, right? And I think that's one area that people don't really look at. They just assume, oh, well, stocks are just going to keep going up. And I think that the challenge is yes, bonds, if inflation's 7% and bonds are yielding 5%, you're losing money to inflation. But you're also setting yourself up for potential failure with stocks if they decline 20%, right? So it's more of this is where I have a bone to pick with the diversification model as being risk management. It's not risk management, it's volatility management, right? Because if it's risk management, there's some of that, but it's volatility management. You're trying to reduce the amount of volatility by having stocks and bonds. Because I think what you're both saying is, well, bonds don't make sense, right? Because at the end of 10 years, your $1,000 will be worth less, but the interest is actually accounting for that difference. And people don't look at it that way. They look at it as interest. So I think there's the misconception about bonds and the value they have, and the fact that we haven't looked at bonds in 20 years, I think has been a big challenge for the marketplace. Is people just don't understand bonds. So, like Megan, with your conversations you're having around fixed income, like, what does that look like? Like, what are people saying to you? Like, what is kind of like the feedback people say if you say, well, we should have more bonds or less bonds? Like, are people really fully understanding it, or you feel like they're a little disconnected because fixed income has been so low for a while?
It's funny. A lot of my clients are fine with fixed income in the portfolio because they see it as the ballast, right? It's that preservation of principal that they're focusing on there. So they're not looking at it in the same way. But other things that we often point out to clients in this is that, just because fixed income might not always be the best place to be when in a high inflationary market, there are other aspects of your financial portfolio to think about. So the other thing we like to point out is Social Security, right? So Social Security and its COLA can also act as a buffer. And we saw that last year with a COLA of 8.7%. Now this year, the rumor is based on where we are today, it's going to be about 3.1, but that is also a way to buffer against it. And I say this because I have seen people put Social Security as part of their fixed income portfolio, as a way to think about it.
Yeah, I think that's a good perspective. Phil, what about you? What are some of your thoughts?
I mean, that's a really good perspective on Social Security. And it's also why I often have conversations with clients around the idea of let's try to wait to take our Social Security, because if you start at 62, you get a much lower benefit. It grows at a roughly 7% per year, not counting that cost of living adjustment, up to your full retirement age. And then from full retirement age to age 70, it grows at 8% per year. And that's kind of a guaranteed return. I can't tell you that I can put money into any other investment and get that kind of return. So if there's other ways and other things that you can do, letting that Social Security grow and that benefit grow, especially when you're a couple and you think about the fact that the survivor of the couple they're going to get the higher of those two benefits when they're the only one left. There's so many reasons to argue for waiting for Social Security, because it's a way to boost the amount of income. And I do think of it, like Megan said, as part of the fixed income component, but just let it grow instead of being in such a hurry. Like some people, oh, well, Social Security is going away. I just can't imagine that happening, because any politician that's voting to get rid of Social Security is unlikely to win re-election. And that's what they all want to do, is stay in their office as long as they can. So, and there's other things that they can do. And it's not that it's ever going bankrupt. All those studies that we see, they're not saying it's going bankrupt. They're just saying it's not going to be fully funded. So they just have to come up with a way to bridge the gap. But don't overlook Social Security and its importance in terms of the role that it can play in your portfolio.
Yeah, no, I think that's really important. And I want to kind of address that really quickly, because I hear this a lot. Well, I need to take Social Security because it's going to run out, or, they're going to reduce it. And one thing I've seen, at least historically, is they might change your Social Security if you're like 30 or 40 or 50. But if you're like 65, they're not changing it. Like if they're changing it, they're giving you like a 5-year window to kind of make it up. But imagine this, you're going to retire and you say, well, I'm going to wait one more year, and then they reduce your Social Security. You're going to have like riots in the streets with old people and walkers like yelling and screaming at people. Like, it's just not going to happen. The AARP is like the largest or second largest lobby in the US. So I think if they're going to do that, which they probably have to within 10 years, because Social Security runs out of money in 10 years. So they're going to have to do something, but they'll probably wait 10 years to do it. And then the question is how do they solve that problem? Because it's not solvable, really, unless you're increasing the date that people are living and you're reducing the amounts. But you can't do that all at once, because then if somebody's planning on it and they literally have no other money, like how are they going to survive? So I think there's a lot of that kind of goes on, and we'll see what happens in the next 10 years. But I did want to address some things, because one thing I really liked about what Oliver was saying was that inflation is not necessarily calculated accurately. And I think this is one thing I've heard the most from listeners and clients and just people I'm talking to, is that they just don't buy the inflation metric, right? It's, we were seeing 30% increase at the grocery store, and yet inflation was like 6, 7, 8, 9, and it didn't make sense to people. So kind of, I imagine you probably both have some conversations around this, but Megan, like, what were some of your conversations around this? Were you hearing this at all from people?
Yeah, I think we've been using this chart with clients, really showing, inflation and it's rising, but also the different segments of inflation, right? Because people are also trying to always get confirmation of their experience, right? So if they're trying to buy a couch in 2021, and not only could they not buy it, but the cost of the couch has gone up, to be able to see that data point, they're like, oh yes, that did happen to me, right? So it's really trying to explain why we saw inflation in certain areas, and then what does that impact their portfolio, right? What does this mean economically? But yeah, I mean, we've talked a lot about it with clients. We're very clear with them, like everybody has a different inflation rate. If you bought a car, you're going to have a very different inflation rate than someone who didn't. But it's really thinking about controlling the controllables. So going back to the long-term cash flow, going back to this idea of stress testing portfolios, it's also, if you feel inflation is impacting your finances, what levers can you pull to mitigate it, right? And it might be putting off doing something because inflation in goods is expensive, or it might be, just trying to be more savvy about how you food shop and things like that in order to feel in control. I think it's really important when we're running our finances, particularly in a market like this where everybody sort of feels there's all these macro out of control issues coming at them, to really think through how can you feel in control. And it's corny, but I got clients who will call me and be like, I did this and I saved money, or I did this. Like, there is a need to feel that they're doing the right things in these challenging marketplaces.
Yeah, I totally agree. Phil, what about you? What were some of your thoughts? And you were talking before the show about some of the issues that are maybe a little bit more hidden in the inflation numbers.
So when I think of things that are hidden in the inflation numbers, the two things that kind of jump out to me is one that you mentioned, Kirk, and that's shrinkflation, which is the idea that go to the grocery store. And I remember if you bought ice cream, it was in a 64-ounce container. Now it's 48 ounces and it costs more. Or if you buy a roll of toilet paper, there's a lot less sheets than there used to be. Or orange juice, they used to also be 64 ounces, like the Tropicana orange juice. And now I think it's 57. So they have, as a secret way or hidden way to raise costs, they shrink the package size. And those are just a few examples. There's lots of other things. So that's one thing that I think about from a data perspective. And then the other is the idea that if the price of beef goes up, they automatically assume that you're going to buy chicken instead because it didn't go up as much. Some people are going to do that. Some people are not.
So explain that, the substitution thing, because I know I learned that in Econ 101 with the substitution. And they talk about how you're supposed to naturally, instead of having filet mignon, you're having sirloin. Instead of having sirloin, you're having hamburger. Instead of hamburger, you're having Spam. Like this sort of substitution. Can you explain that a little bit more? Because I think that's something that I haven't heard people talk about it. I've heard shrinkflation, but I haven't heard like the substitution get talked about much.
So it's just the idea that when the price rises to a level that's too expensive, if you want to buy, you use different types of steak. I said steak versus chicken. It's all the same thing because it's meat and protein. And if the one that you would normally buy is too expensive, you step it down and buy something that costs less. And when they're calculating the numbers, they're assuming that you're going to make that choice. Not everybody does. So I guess the other option would be, instead of getting a lesser quality product or getting a slightly different product, is you could just consume less. But the numbers, my understanding has always been that the numbers that they use to calculate inflation kind of assume that when this price goes up by a certain amount, then you're going to buy something different that costs less.
Okay. Well, cool. So let's, as we kind of wrap it up here, Megan, what are some final thoughts you can give the listeners about, inflation, how they should be thinking about it, and where can people find more about you?
Yeah, you always have to assume the economic environment is always changing. So when you're doing your planning, when you're really trying to figure out, can I retire? How do I retire? Really reflect on factoring in inflation into your portfolio. And at the same time, like both Phil and I talked about today, really think about not just the dividends coming off the portfolio, but your total return and how that can help mitigate inflation risk. So I'm Megan Gorman, and as a bit of exciting news, my book is going to be published in the spring of 2024. So we have just launched an Instagram account. So follow along. My book is called All the President's Money: How the Men Who Governed America Governed Their Money. And on Instagram, we're at All the President's Money. So Kirk, thanks for having me on.
Well, thanks for letting me know, Megan. And this is the first time I'm hearing about it.
That element of surprise.
That's awesome. Well, that's great. We're going to have to promote that in the show. I didn't get any.
I'm hoping you'll interview me at some point once I'm published.
We'll see. I don't know. Not telling me, Megan, and popping it live in the show. We'll see. But that's awesome. Congratulations, Megan.
Thank you.
And Phil, final thoughts from you, and where can people find more about you?
So one thing that I think about, and I always tell clients, we do a financial plan, and things are not going to go exactly the way that they are in the plan. There's so many things could be different. What you want to do and what your goals are, they could change. How the market performs can change. Inflation can change. That's why we want to stress test, but also that's why we want to go back and we do a plan. It's not like it's one and done. It's an ongoing process. We want to review and update that plan to make sure that you're staying on course. And if there's things that change, whether they be in the environment or for you personally, that they get reflected in your plan and it gets updated to show that. And also the other thing that I think about, I have a conversation with clients a lot about, you may have to lower your targets on some things, like people that wanted to buy cars in the last couple of years. The car market went crazy during COVID. It's getting a little bit better now, but it's still not where it used to be. Well, maybe you need to either get a lesser car or get something used, though those price spreads on the used aren't what they used to be. But still, you want to think about, there might be times that you need to make some adjustments because of the environment that you're in. And inflation is one of the things that can cause those adjustments. As far as where to find me, my firm is Apprise Wealth Management. It's apprisewealth.com. I also have a free ebook at apprisewealth.com/ebook. Thanks, Kirk.
Great. Well, thanks for coming on the show, Phil. Thanks, Megan. That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.